everyone, welcome to Fearfully Greedy. In today's episode, it's been over 1200 days, so we'll do a portfolio update, just the recent news of the companies of the channel. I try to do this every quarter, but not very good, so we'll try now. If it's good with you, I will go over biggest position to smallest position, and we'll go back to research next week. I will try to find something more organized for the sharing of the ideas of the week, but we'll see. I will keep showing you. We're sitting at 37,350 euros. I said it's been over 1,200 days, so it's been quite a few days. We're at over 5% positive, which is very flat. Like if we think of 3 years and we are 5% up, this seems like I don't know, like it seems like a currency portfolio or something crazy. Okay, let's go to Warrior. Warrior has had a good quarter. The price is now settling more into the normal range. It's still elevated. Like in my original model for Warrior, $200 was not the average selling price. So we are still very happy. We wish the production had kept up or had increased during the last year when the prices were crazy, but we're happy that the production is going up, and we're they are selling more now, 5,900 tons this quarter, for the 9 months. So this for the 9 months, sorry, which we had a bit of a higher inventory last quarter. So it's good that it's trending now at the moment. Sales are much higher in Asia this year. If we compare to previous year, we can see that Asia was 21% last year for Q3. Now it's 31%. Oh, sorry, year to date again. So it's not the quarter, year to date. If we see the quarter ones, it's even higher. It's like 50% for Asia. So they are selling more and more to Asia. Is that good? I don't know. The route is not very efficient to Asia, so I guess they're finding a good deal there, but they shouldn't have an advantage there. They have a much higher advantage in Europe. Then about Blue Creek is just coming nicely. If we see what it will eventually be, this is pro forma, so we don't really know. As always, I say that until the ink is not in the paper, we cannot just know these things. But it should make the the Warrior even better cost effective, like less cash cost per ton, which should is great. These are pictures from the sites, the slope site, and this was the treatment plant. If I'm not mistaken, the project remains on schedule for second quarter of 2026 to start the first longwall. They still give this number, which I said there was a study that was lowering it, but they still give this number, with 159 million short ton of coal reserves. I think maybe they know something more now, but they are still giving these numbers. So maybe it was just a technical thing that how do you say that paper that someone was analyzing the land and saying that there was not that many tons, or that they were not proven they were probable. So we'll see. Well, they say reserve for sources and adjacent properties, so they take all into consideration, and maybe it's that, or maybe not, or maybe it's less. But I will say it again, Warrior doesn't need Blue Creek to 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 be profitable. They are spending a lot of money on it, but my original thesis was without Blue Creek. With Blue Creek, it is crazy. Okay, next up, Carvana. Carvana posted also the quarter update. What they had is that they keep shrinking costs. As for cost of sales and also for other expenses per car, they peaked, as you know, in 2021, and they have been keeping them down and down and down. So this is something that is also is improving. Uh, it will be very good once they reschedule or go back to growth. Then they had a net income, like a net profit of 770 million, which is not true. Okay, well, not I mean, accounting true, but it's not. Cash flow is not that. Okay, so if we see the gain on debt, they did that debt swap. So they bought it and they made it longer and higher price. So with that, they say that they made this gain. But this is not a they didn't have a net income this year. This quarter they had EBITDA, right? Positive. Another point that they made this quarter in the shareholder letter is that there's much more capacity. So they could be doing like 5 times more cars with not much reinvestment. We will see. We will see. But I'm happy they are focusing first on being profitable, and then we will scale it. I like that. Then for retail units, we had a uptick. So now they did 81,000 units. So that gives us some hope. Okay, we are not at 117 or 113 or 119, but at least we may they are much more profitable here. In the previous, I wanted to see this here. If you see, had 480 million of gross profit. Suddenly, there's 50 left, and interest expense was 150. We hope, in theory, the 150 will go down next quarter. Okay, but they lost money this quarter also. Oops, like all the quarters. Let's go to PAX. PAX, well, you know what it is. They make POS, so they make these points of sale. They will have a muted year this year for 2023. Revenue should decrease 10%. Gross profit margin is constant. Operating profit margin is slightly lower. They keep buying shares, so shares keep shrinking. They bought 43 million Hong Kong dollar shares. It's not a big buy, but it's nice. The total payout is 35%. They are being able to invest enough to keep the business as number one technological POS in the world, and they just keep taking market share for everyone. It's a muted year for everyone. The like sales are flat or going down this year for everyone. But yeah, the dividend keeps coming in. I have made 390 euros more or less since June. So since June 390 for a position that is not that big, it's not that bad. The thesis for me is intact. If we see the last half years, we're at maximum net profit margin and gross profit margin also at maximum. So muted year, but efficiency is up there as always. Then Naked Wines is that online website that you buy wine from. They make the wine. They source local winemakers, professional winemakers. They make the wine with them. They pay them for per bottle, or they agree on some amount, and then they distribute it to their subscribers. So it's like a subscribe business. I have a thesis, so if you wanna watch that, go to the channel. The thesis is pretty much the same. The numbers have changed a bit. I will make a point here that Naked has probably not become what I thought yet, and but it's also not trending in that direction as of now. If we see they had a huge uptick on COVID, like on the pandemic, and then it just didn't materialize. I do still believe that the long-term prospects are intact. They do 350 million, like 200 large is US. That's such a tiny amount of the total addressable market. So the opportunity is huge. It will be hard, as we are seeing. It's very hard to explain it and to show customers the benefit, but I do believe the model is still very powerful compared to the alternative. So if something else comes up, like I don't know, like free marketplaces where wineries can sell their wine directly to customers and someone just does the logistics in the middle, would that be better? I don't think it will be cheaper per quality, but maybe better in some way. You would feel more directly connected to the winemaker, and they can do their own thing 100%. I don't know. I don't know. But from the alternative is much better. Management has been able to reach the high quality customers. So if you see 2021 to during all 21, they made a lot of new customers, new angels, but they lost a lot also. So the retention from these new customers is not great. The usual would be that this difference is super high quality, so it's worth it. But if we see now they are losing more than they are making, that's also because the payback for the investments they were doing in marketing and promotions, they were not paying off. So they are having a huge problem in reaching this high quality customer effectively. Do I think they can? I think they can. I mean, I think I know those customers exist. It just they need to find the way to there. Cohorts of angels, which are the subscribers, of 3+ years are so valuable. If you take a moment to look at this graph, if you see what you had from previous year to next, it's always like 3+ years. Okay, um, the churn is so small. Okay, so they just need to find this high quality customer that wants these high end wines at less price and being able to talk directly to the winemaker. And another model, does this substitute like visiting wineries and buying some in the store? No, but this is it's some value proposition. I don't know. I'm a sucker for these value models, so I will also get trapped into those. But Naked so far has been a huge loss, right, for the portfolio. Then Baba, well, just few points. Maybe I didn't talk about them, but they have done like a business split reorganization. So it's not that all of them are going for IPO, but they wanna decentralize like the management of them so they can thrive and grow and be profitable by themselves. These six business would be these ones: China commerce, would be the online stores in China mainly. International commerce, so AliExpress and Alibaba. I use these two. The other ones, same thing, but in other um, verticals. Local consumer services, that's in China, and this food, and these like maps in China. Okay, now shipping, like logistics, cloud, and then digital media. They do some content. This we won't talk about. Okay, what's let's take a look at these ones. If you see here, this is mm, revenues. Okay, yes, revenues, EBITDA. If we see the online stores in China, they are half of the revenues for the business consolidated. That's okay. So we should give half the value to this, and the other should come from other places. But that has never been true. Taobao produces over 100% of EBITDA. That's because it's paying for everyone else. So the online commerce in China is the big thing, and it's what is profitable, and the other ones are not at the moment. Can they be? Sure, most of them can, but none of them have been profitable yet. They are shrinking the difference. The profit is coming closer, but still not yet. Maybe that's why they wanna push them the other side, and so they can be profitable from now on. But if you're trying to value Alibaba, the main thing you need to do is value their online commerce business, and this would be like good, positive, possible bets in the future. But even cloud is not there yet, so I will do that. There will be a spin-off already from Cainiao, which is the shipping logistics provider in China, and well, they get it everywhere. They will hold more than 50%, but they will spin off the share. So there will be a public offering. If we see year end, so last year, we could see that the Alibaba, the growth has slowed down dramatically, especially like China Commerce, which is the big dog, shrunk. The others grew. This is revenues, okay, so only revenues, but this in the middle grew. So online stores, the food and the maps and that got local services, shipping and cloud all grew. Digital media shrunk. Innovation and initiative shrunk even more. Okay, so growth has slowed down. If we take a look at the last 3 months, we are quite back to growth. So 12% on the big dog, I like that. 14% total, I like that. So we're going kind of back to grow. Cloud is growing, but so timidly. So all the others are growing pretty good. So we might be back to growth, but that requires maybe some rethink on valuation. The share count shrinking, so they have been buying shares back. Uh, they have bought like it was 3.1 billion dollars, and there are 16 more, so they might buy 20 billion dollars almost. And the company is valued at the moment at 200 billion dollars. So they will, if the market price stays the same, they might buy 10% of the company, which we need to take account in the calculation. But yeah, I had to do like a valuation adjustment and put it down. If you remember, I had it at like at 200, and now I have it at lower, at 140. So I value it the more muted growth, maybe more like 10%, and then slightly lower after the 5 year, and then the valuation for Ant has also shrunk so much, like 75%. They did like they did the share buyback, which gave this 78 billion valuation. Do I think it's 78 billion? No, I value it at 120. I don't think it was made to 130. Maybe it was. It's not a public company, so we don't know the numbers, or I cannot know the numbers. If someone can, let me know. But yeah, my valuation now is 140. That gives us less margin of safety. So think change, like business change and adapt. I think Alibaba still has great prospects, but valuation is a bit lower. And NAGACORP, just very quickly, they posted like an update, a trading update, and they are like 82% back to pre-pandemic business volumes. EBITDA was $215 million, and the group cash equivalent was 297 million. They still have some debt, 174 million of debt. So there was also an update on 17th of October where Dr. Chen wants to help out with the debt. So he offered 80 million to the company at some rate, and it's to pay the 2024 notes, which were like 400 million or so at the moment, at its time. With the 80 million, the cash flow, well, that's what they say. Let's see here. With the 80 million, the 324 million of cash and bank balances, 404 in total, is sufficient to pay the 2024 notes and with the cash generation as of now. I do think so. NAGACORP worries me not one bit, so we're good with NAGACORP. And then last one, RAI International. RAI International has been also huge mess, like big loss. They announced a new contract, but it's very fuzzy, so there's no exact numbers. There's a sub-allocated lot amount from the British government for some services over the next 2 years, which the total lot is 375 million. We don't know what amount is for RAI, for RAI International, so we will need to wait to see more detail on this. But it started 18th of September 2023. Some of it should come. So new contracts, some positive news. Then they did like a capital reduction, which it's the first time I see it in one of the companies I own. I think I'm right on that, but it's not very common. I think what has happened is that there was a share premium account. So when you issue shares at higher price than par, there's that amount is registered on the equity part of the balance sheet, in and it will sit there forever. Okay, and you can use this amount to pay some issuing costs and some other stuff, which it's equity, like it's not money. Okay, it's like value if you want, but it's not money or anything. So it's like an accounting thing. What they say they are, what I don't like is that their head is on paying dividends when they are going broke. So it's not something I like. Um, but this is where their head is that since at the moment their retained earnings, so their distributable money is negative, so they have negative retained earnings. They cannot distribute dividends. So what they propose is canceling the share premium, so the balance is now positive on the distributable part. Do you see here share capital? It's the share at par. Share premium would be this premium when they issue more shares. The merger reserve is something when they merged and there was some like a negative factor to the equity value for RAI International, and retained earnings, well, in the last 2 years has become negative. So this is the only part that it can be distributed, if I'm right. So by taking this out, this should come from the balance of this should go up because the total equity still needs to add to assets minus liabilities. I don't know. We'll learn something here. Still, not much else to say. We'll need to see the contracts. We'll see if business resumes. If not, the position has shrunk so much that I will let it let it write itself out. Okay, that's it for today. Next week I will bring you some research, so new stocks that I'm looking at. Probably we'll do top 5 of the week instead of 17 or 6 or whatever. I will maybe talk briefly of all the stocks I looked at during the week, and then show you more in depth maybe those top 5 that I liked. Okay, well, everyone, be safe, take care, bye bye.